Well, good evening, ladies and gentlemen, and welcome to this Christmas webinar. Amazing as it seems, it's amazing to me, I can tell you. Christmas has crept up and the end of the year is upon us. In fact, next week is Christmas, and that's pretty staggering. Anyway, good evening to all of you, and good morning, and indeed to some of you, good afternoon to our friends in the Southern Hemisphere. Nice to have you all here with us today. Loud and clear in Auckland. Oh, Pete, hello, mate. How are you? Don. Don got back to Canada from the Waiheke tutorial. Still jet lagged, but going strong. Good to hear, mate. Welcome to all of you folks. Particularly welcome to those people who were at the Waiheke tutorial, and to all our old friends. Alan Varian, happy Christmas to you, Alan, and your family. Chase is with me. 2017 might be the year I give up smoking. Chase. Daryl from South Africa is here. Hello, mate. Hope you got home all right. John, oh Lord, look at me. All our friends are here. Jerry, hello, Jerry. John Barnes, Kurt, Boyd, Marcel, my friend. Happy Christmas and a very merry Christmas and a happy and prosperous New Year. I read an article in the one of the New York papers today that you absolutely cannot say Merry Christmas in New York. People get terribly offended. I have absolutely no idea why that is, but I'm way past the age where political correctness means anything. Michael, hello, Michael Peel. Haven't heard from you for a while. We were talking about you at the webinar, mate. It was good. You forget that the original saying was a Merry Christmas and a prosperous New Year. So, if you don't like the Merry Christmas piece, I'm sure we can all agree that a prosperous New Year is something greatly to be desired. No better way to get that guaranteed than to learn how to trade futures properly, Steve, as you're going to do next week, mate. So looking forward to that. Sue Lee's with us. Terry, hello, Terry's with us. And Tom Jonovic. Yes, Tom. How's that working out? All right, so what are we doing here? All good. Everyone's here. Okay. Folks, while I was looking for a banner for this webinar, I came across this one that you see on your screens now, which, of course, for those of you who don't know, this is our hero, Daniel, and this is a painting by Michelangelo that's on the ceiling of the Sistine Chapel. And of course, Michelangelo had no more idea what Daniel actually looked like than I do, but it shows him as a strong, vibrant, vigorous young man, hard at work on his papers. And it's certainly been a great year of trading. It's been absolutely fabulous. But I noticed when I looked at this particular picture that one version I saw we'd used for the 2013 Christmas webinar, we talked about gold, the US dollar index, and the S&P. And that's pretty much what we're going to talk about today. They're still very, very dominant, important markets. As you know, the Fed, Mr. Deck, hello, mate. As you know, the Fed raised rates by a nominal 0.25%. And telegraphing that any future raises will be slow and deliberate, but they've managed to bite the bullet after almost 9 years. And interesting thing's going to be what happens as they start to drain liquidity from the system, if indeed they're going to do that. The operations of the Fed really are so opaque that although there are millions and millions of words written about it all, it doesn't really it doesn't really tell you that much. But markets will know and markets will anticipate, and that's what we're going to look at today. Let's see what else we have here for you today. First of all, yes, of course, thank you, Waiheke. Some of us have just returned last week from the tutorial at Waiheke Island. That's part of Waiheke that you're looking at there. It pretty much all looks like that. White sandy beaches, beautiful, beautiful place, and particularly enjoyed it. Was absolutely fantastic. One of our best tutorials ever, I think. Great fun. We didn't have any sort of party leaders. It was a pretty circumspect affair. Normally we have one or more party leaders who manage to get everyone into trouble, and that didn't happen this time so much, although a couple of our boys managed to get themselves into trouble anyway. I'm just seeing if he here. No, Mark is not Peter. Anyway, it was great. We went out on the boat with Pete and Phil. Pete's with us today. He came to the tutorial. They're both coming over to Los Angeles in late May, our next Daniel Code tutorial. So it was a terrific trip around Auckland Harbour and the Hauraki Gulf, and then we had our cocktail party on the Monday evening, which is really a welcome, a meet and greet. It's a very informal affair, like everything we do. We try to keep things just simple and calm. And then teaching Tuesday, Wednesday, half day Thursday, and pretty fantastic, I thought. So thank you to all the people involved in that, but a particular thank you to Daryl and Sage. It was terrific having them there. Daryl's the second person I ever taught the Daniel Code to many, many years ago now. And Sage is his lovely wife and a great one of our very, very best traders. And it was good to have them there with us as people who've been with us for a long time. And they could give good insights to some of the newer members. And Sage and Daryl took over the teaching of GMAG, which is one of our trading programs that I teach you at tutorials, and just did a fantastic job. Everyone was most grateful and appreciative of that, and that really helped help the newcomers along a lot. In fact, Sage did a couple of sessions showing people how to build their charts, how to place orders, did a lot of work, including some early starts. In fact, good. Daryl's gone off to a boozy boys' lunch. Sage got to go and pick him up. Yes, it's not too bad over here, Sage. It's a bit warmer, but it's under 30. It's just about perfect pool and Bloody Mary weather, which is it's Friday where I am. Of course, for you folks in the Northern Hemisphere, that's what we usually do on Friday. Anyway, thank you, Sage, for that effort. It was absolutely fantastic. So we're just going to run through a couple of slides here, folks. Nothing too important. It's getting on the charts that's really going to be the important part of today's proceedings. But tells you what we do. We're primarily 1 to 8 day traders in futures and forex. We trade a huge array of markets, all the big time equity markets, and most of the more liquid futures markets, and 16 forex pairs. For those of you who are not familiar with what we do, if you'd like to have a free trial of everything that we do, this is all you need to do. There's a banner on the front of the Daniel Code website at www.thedanielcode.com. You click on that banner, create a username and password, email your username to Terry, who runs the website for me, and he will switch you on to everything we have for a 31-day free trial and get you started on that. This is our compliance statement. I'm required to show you. I'm always anxious to show you there's considerable risk in trading futures and spot forex, and there's even more risk if you haven't learned how to trade it properly. And the reality is many, many people try to trade futures and forex believing they can learn what they need to know from the internet or from books, and the reality is that you can't. You need to learn properly how to trade safely and profitably, and to do that you really need to come to a Daniel Code tutorial, although I try to teach you a lot of the basic stuff at these webinars. Okay, so let's move on and let's talk about gold. I had an email just came in yesterday from Deepak, who said, let's see what they all said. Here's who said you want to know if I'm going to be talking about gold. I'm nearly always talking about gold at these webinars, rather, because a lot of people trade gold, and in fact, it's a great trading market. And he wants to know if it's time to buy. Is it a good time to buy gold? Well, the answer is it's always a good time to buy gold as long as you know when to sell gold. And the point of that, Deepak, is to tell you that we are gold traders. We trade the COMEX futures contract. We are not believers in buy and hold anything. We trade what the market has in front of us, and this buy and hold thing is got some problems with it. And I'll just tell you a few little points that some of you may not be aware of. And the first would be that when I met Pete over at Auckland Harbour in their nice Phillips nice 40-foot, 42-foot, I think it is, game fishing boat Game On. The first thing I found out about him was he's a gold bug, and a great believer in buying and holding gold bullion. Now, this whole gold bug story is largely manufactured. I don't mean to offend any of you by this. I know there are lots of you that are holders of gold bullion. You deeply believe in the inherent value of gold. I don't, but I don't wish to offend you in any way. But there are just a few things I'd like you to think about. The gold bug story is really driven by a massive publicity machine that argues, one, that paper currency or fiat currency is inherently risky and not really worth its real value or whatever value is attributed to it. The other point of the gold bug story is that the price of gold is systemically repressed by major bullion banks and gold traders, and the true value of physical gold is many, many times higher than it is. And as an example of that, I was talking with Pete about the story that gets a run pretty well every month, that there are massive paper claims on gold, by which the authors of these articles mean the futures contract. They add up all of the futures contracts and say, well, you know, if all this gold had to be delivered, then there's not enough gold in the vaults or probably anywhere else to satisfy that delivery. And that misses a couple of important points. And my friend Pete used to believe that until he met me and we had a discussion about it. But basically, the net value, the net amount of gold required to settle all of the COMEX contracts is nil, because every buy contract in COMEX is matched with a sell contract. If you buy a contract of gold, which gives you the right to have a settlement of the commodity, and on the terms that are set out in the exchange's description of the product at some future time, then you are buying the rights that come under that contract, but one of them is not the certainty of delivery of the physical product. So first of all, every buy contract in COMEX Gold is already matched with the sell contract in COMEX Gold. So they all net off. The net amount of gold required to settle all COMEX contracts is zero. The other point is, if you have a look at the conditions set out by NYMEX, all COMEX Gold contracts can be settled in cash. There's no requirement at all for any seller of a COMEX Gold contract to be worried that they're going to be forced into delivery of physical gold. So, you know, that's just a great story, but that's a story that's designed to urge people to buy not futures contracts, but physical gold. So the people who push these lines are people who are interested for their own commercial reasons in selling bullion, selling physical gold bullion. And it's a pretty fraught business. You can't find a more accurate price fix for gold than the daily settling price of COMEX Gold, which you can discount for the length of time of expiration of the contract to get a net cash price pretty simply. You can't buy bullion for that price, and you can't sell it for what the market says you can sell it at. There's a margin that dealers maintain, but there's this constant underrowing of propaganda to try and get people to believe that there's a great shortage of gold, that it has an intrinsic value many, many times more than its present value, and they should be buyers of bullion. So I think we pretty well, Pete said I've changed my view on gold. I mean, I think, I don't mean to be rude to anyone, but you have to be aware that there is a constant campaign to promote the buying of gold bullion, and in the same way as there's a constant campaign to have people buy stocks and shares. All of you have seen these indices that go up and up and up all the time in equities markets, and in fact the exchanges and the brokers use that as part of their marketing tool. This market's always gone up. This market always rises left to right. Well, yes, the index does, but the point that most people don't realize is that the index that you see today is not the same as the index that you saw 10 years ago. In fact, it's not even the same as the index you saw 6 months ago, because equity indices go up because they're engineered to go up. It may be there's inherent value in them, or it may be that you're comparing apples to oranges. But the main point about equity indices, in fact, all of those indices, is that they are resettled periodically, some of them quarterly. And what the exchanges do, or what the people who sponsor the index do, is they take out the worst performing stocks and replace them with the hot new thing. And indeed, in the US, stocks that trade below a certain dollar value for a certain time are automatically removed from the index and replaced with the hot new thing. So it's not really comparing apples to oranges, it's comparing apples to oranges, because the index changes to take out the dead wood and bring in the new vibrant stuff. And that happens on a regular basis. And I'm not sure that that's ever made terribly clear to people. But there's things are not always what they seem, as we say. But let's, in the meantime, turn our mind to gold, which is at a pretty interesting juncture. This is the weekly chart of gold, and you'll recall we found this low back here in July 24. It ran up to this rally high on October the 16th. This is a weekly chart, calendar week chart, and right there we found a Daniel code resistance number of 1190.8 against the high of that bar of 1191.7, and we had a 44 time cycle, which is the primary time cycle for gold, although it does run off other time cycles as well. And then it started this march down. Now, just let me take you through this so you can see what's happened. I know you've seen this chart many times. I show it to you regularly. And here's the first push down. And just keep an eye on these numbers on the right, these red numbers here, which are the Daniel code retracements. And they're quite extraordinary that they show which of the retracements the market is following, and they give you some pretty good idea of what's going to happen going forward. So this first big bar down put in its low for the week at 1138.4. If you just look slightly to the right of that bar, you'll see there was a Daniel code retracement level at 1138.6, which showed thus that the market was saying, yes, I know about these retracements, I know where these numbers are, and I'm tracking them. And once it starts tracking them, it tends to stay tracking the same sequence, and that's exactly what happens here, as you'll see. So then we had the next week, which ended on November the 6th. We had this big bar down, and that took us in a great rush to the Daniel code black line. 1085.4 was the number. The low of this bar was 1084.5. So less than 1 point in a market that's measured in 1,000 plus. Very, very small variance. So there's your perfect target recognition. Now, there's something special about the black line, that the black line is the last level of support and resistance in any market swing, and this is a pretty classical market swing. Whereas all other retracement levels work on the bar high, low, or the close, the black line has the additional feature that a close below the black line in a downtrend signifies that the swing is probably going to go, and that's a very high probability. So we had 1106, we had this bar sitting right on the black line. The next week, 1113, we had a close below the black line. The black line is at 1085.4. It closed at 1083.4, and that was our clue that the swing was going to go. This is the swing over here. I know this red line might have confused things a bit, but this is the swing low here from July the 24th, and that low is 1072.3. So just as the chart was trying to tell us, the very next week that swing's taken out pretty dramatically. And you get an acceleration down, and it runs down to the blue line, the Daniel Code blue line, which was at 1051.7, gave us a low here at 1051.6, and from there you got a response. You had a 44-day cycle expiring there, one of the dominant numbers for gold. That's a time cycle. You had the stochastic oversold, you had support from the blue line, so it rallied. And where did it rally? Straight back to the black line, 1085.4. The close of this bar is 1085.8. I mean, it's extraordinary how markets run to these Daniel Code numbers, which are not Fibonacci numbers. They are not old highs or old lows. Unless you are a Daniel Code member, they are nothing you've ever heard of. And they're known to very, very few people. We're a very, very small group of people. And the fact that these markets run to these numbers all the time is the key to trading. And if you're not using them and understanding what they can do, you're probably not getting the most out of your trading. Anyway, this time the black line served as resistance. The market stopped right there, a little bar down, and this week, which ends tomorrow, Friday, it's now back into these blue lines again with a close for Thursday's close of 1050.1 against the blue line at 1049.8. So it's just tracking this stuff very, very closely. And what happens from here? Is it a good time to buy gold? Well, not bullion. That's a different caper altogether. If you're interested in buying bullion and having a buy and hold mentality, this is not the place for you to be. We're traders here. I mean, I love gold. I trade gold all the time. It's a fabulous trading market. In fact, we chose gold for the one of the trading exercises at Waiheke, and all the guys at Waiheke, and the gal, Sage, not forgetting you ever, of course, how could I, actually traded the COMEX gold chart for the whole of 2015 without making one incorrect trade. Now, let me clarify that. A wrong trade does not necessarily imply that all trades are profitable. You can be right, correct with the trade, but the market just doesn't move away far enough to give you a profitable close. That's just the price of doing business in trading. But we got the Waiheke group the stage. They could trade gold for one whole year and not make one single mistake in their trading. And that's what I can teach you if you want to come to a tutorial. Reminds me, the next one is in late May in Los Angeles, in El Segundo, where we were last year, Manhattan Beach. And then I've already booked us into Waiheke for next year. Any of you who want to get back to Waiheke, the Daniel Code tutorial in Waiheke next year starts on the 4th of December. Okay, so there's the gold chart. It tells a whole lot. Let's move on and learn some more about it. Now, this is the 6-day chart in gold, and you can see that it's been ticking off these numbers, these Daniel Code numbers, more or less. It's got times when it's been very accurate and times when it's not so accurate. But this was the high here. This was September 2011. As I love to tell you, because it doesn't happen often, we're running a tutorial in Colorado Springs at the time, and I told I told all the class that was the high in gold for probably at least the next 10 years. Some of them went out and sold a great deal of gold bullion right at the market high. We had blue line trades, we had TO3 trades on the day of that high, and some of those guys are very happy that they did that. So let's track what this chart's done since then. It came down here. It had a bounce off our first retracement at 1554.6. Rallied up, had another bounce through it, pretty sloppy at this stage. 3-4 weeks of the same sort of stuff here, another rally, and now it starts to find a bit of precision. It came down here. This is February 28th, 2013. It found that 1554.6 number very accurately, only 3 ticks outside the number. So this is when it starts saying to you, I know these numbers and I'm tracking them. And down it comes again, runs through a few numbers, rattles around, finds a bit of support on the close here, eventually drops all the way down to the 1186.8 number, which causes a big key reversal bar, and you get this multi-week rally. Then comes down, it has another hit at the 1186.8, and this is 1181.4, this bar, a little bit of a push through, back up again, sustained rally, down again, low of this bar is 1183.3, so you've had 3 times it's been telling you it knows this number. Then you get a little break of this number. There's some minor numbers, blue line numbers underneath there. Rally back up to the 1302 number, and a little push through it, and then it starts to drift lower. We get an intermediate low here, which is at a blue line number, and then the rally back up again to test the 1186.8 from the other side, which really makes you think, doesn't it, that this next number on the 6-day chart is likely to be the next level of serious support for gold, and that number is at 1001.6, and that's on the 6-day chart. From there we can go and have a look at the longer term chart, just so where's our trend one? Here it is. Everyone can feel happy, because really, look where gold is. I mean, it's still massive price. It's around a decade and a little more, from down in the 200s up to 1800s. It's still well up there. Yes, it's given up a lot, but if you look at it on the overall scheme of things, it's still holding a strong position. In fact, all it's doing is correcting the first swing. It's correcting this swing here from this high down to this low here. And that's only the minor swing that it's correcting. So technically gold is still in a strong position on these charts, but whether it's going to be able to do anything on the upside, we'll have to see. But whatever it does, it will be bound by these Daniel code numbers, and they will guide what it does. Let's just go. There's an interesting situation in gold right today. Let's go to the daily chart. Just let me see when this has changed for you. Audience view here. Yeah, you got it now. Okay, this is a daily chart of gold, and just where we are right now. This was the last low on the Daniel Code 44 cycle, and then you had this sort of a big rally up, little wander around, 1 bar up, hit the 59, down it came. In 2 days' time, in fact, on Monday, you've got a 62 time cycle expiring. 62 is traditionally a support cycle. It more often than not gives us lows in the market, and these time cycles are valid to plus or minus 1 period, and they're more accurate on the longer term charts, 6-day charts, than they are on the daily charts. But we have not quite a moonbeam here. But what we do have is we have this close right at the black line of the daily swing, and the daily swing runs from this high here, December the 4th, down to this low here, December the 3rd. You can see as this market's worked its way down, it found this 1069 number here. It was sloppy around the next number of 1062. It then did nothing as it tried to rally, didn't come off a number, and now it's had Thursday's big dump down that closed at 1050.1. The Daniel Code black line is at 1050.1. And the point of this, just to refresh your memory, is that this is potentially a hook trade. And hooks come with retracements that run to the 74, 89, 100, and 114% Daniel Code numbers. This black line is at 89%. It's the prime candidate for a hook trade, and it's come within 7 days of the low, not counting coloured bars. coloured bars are the inside bars and the outside bars. And there is a possibility of a snapback reversal here, either on Friday or on Monday. We actually have a daily buy signal on gold for today. Remembering, if you would please, that all of these signals are conditional and mean nothing until they are elected. And to be elected, this market would have to trade above or at 1072.9, which is 2 ticks above the setup bar, which is Thursday's bar. So just keep that in mind. It might be an interesting trade. Hook trades, if they happen, you can expect them to be bigger than normal trading moves. So I wanted to just alert you folk to that. What else do we have to talk about here? Yeah, I wanted to see what the Full Seal has for you. Let's go to the Daniel Code website, and under here you'll see these are the 4 seal markets that we cover, and one of them is gold. Let's have a look at that. These are a lot of this work is done by Frank DB, who assists me with the Full Seal charts. And you can see this is the first chart you see here. This is a 24-day chart. And look at all these time cycles you've got: 59, 44, 62, and 70. All of the Daniel Code time cycles are clustered and may well suggest at least an intermediate low or bottom. Markets turn at these time cycles as well at the Daniel Code price levels. The next chart down, this is the 6-day chart, and you can see on the 6-day chart there's a 59 and a 62 cycle ready to expire right now. And then if you move over to the last chart, here's this cluster of the 44 continuing to repeat. 62 was last week. This week is not completed. This chart was posted on Monday, so it's almost a week out of date now. But you can see the updated chart next Monday. And in the meantime, you can read Frank's view of the market here, what he's talking about. And if you'd like to have this information on a regular basis, you're more than welcome to subscribe to one of our Full Seal programs, or all of them. And the interesting thing is that even though the focus on these Full Seal analysis is to find future market turns, the fact is that they also give you a very unusual read on trend that's not generally visible to other people. And if you just bias your trade slightly towards the Full Seal trend, you will see that you get very, very superior returns just simply by doing that. Okay, let's move on. We can get rid of him, and let's go and look at our 6-day chart, which was the last one for gold. Here, I'm not sure if I've shown you this, but there's your 10016 number, and underneath that is the first of the black lines, 981.5. If it gets down that low, it'll be very close to being back. This is a Full Seal line, this red line. And there's potentially an intersection of that on or about January the 7th, plus or minus 1 period, and that should be very powerful. Okay, so we've done all of that. Let's move on now and take a look at US dollar index. Remember, your gold, if you're talking about COMEX prices, is generally quoted in US dollars. So what happens to the price of gold is very much affected by the value of the dollar. And you can see here that you've seen this chart a number of times. This US dollar has been on a roar for a while, and we started looking at this chart, here we are, back a few months ago, because I wanted to show you these Daniel Code retracements that have been guiding what it's been doing. And we had this 59.3 retracement, very important retracement, at 100.830. And the DX, which is the US dollar index, this is the futures chart, hit that level way back in March 2015. And it hasn't been able to exceed that level since. From there, look what happens. It has a little rundown, goes down and bounces off the earlier Daniel Code, the 44 Daniel Code price level. A little rally, goes down, breaches that, says, oops, sorry, puts in a higher low, and it's been back trying to get to that 100.830 level again without success so far. So we're going to look at a longer term chart, but what you need to take from this is that technically on this time cycle, remember, you can't talk about trend unless you also talk about the time period, because markets have different trends going on inside them depending on the time cycle that you're looking at. But on the 6-day chart, the trend is still technically down. And even though you see this, pretty impressive rally here, certainly turns the trend up in shorter term cycles. But on the 6-day chart, this trend is still down. However, a close above on the 6-day chart, a close above 100.830 will change the trend. That will give us a second confirmation that the trend in this market on the longer term charts is up. So what happens with the US dollar index, very interesting. The theory of the Fed rate hike, marginal as it was, 0.25%, it should strengthen the dollar. That's sort of the current thinking. It should strengthen the dollar. It's a sign that the US Fed, which has been extraordinarily timid, has enough confidence in the US economy to raise rates a little tiny bit. None of that makes any sense to a rational person, because if you see what equities have been doing, the rest of the world has been quite convinced that the US economy is very sound and growing, and that's why the equity indices have been roaring up. But the Fed has been far more cautious, very data dependent. They look at various types of data, and it's only now that they've had the confidence to start to raise interest rates. It should be positive for the US dollar index. So far it isn't, but it might be. And that's the thing to look for. If we get a close above 100.83 on the US dollar index on the 6-day chart, we can look for a bit of a breakout in this market, and which is, about time. It's well and truly been depressed for a long time, or suppressed, I should say. Let's have a look at the longer term chart, and let's go to DX on this. Here's the previous gold chart. Let's go to the US dollar index now, and you can see that this is not even, this is a 2001 high in US dollar index. Traditionally, it's been very much higher than that. You can see we're not going to be able to, we don't actually have all the data, but you can see it was way, way much higher than that for many, many years. So this is a fairly suppressed price. Obviously, in terms of US trade, a cheaper dollar helps exporters, and that's very much a consideration as to where this US dollar index is allowed to go to now. Don't believe for a moment that there's much free float about currencies. Almost all currencies are managed by the governments and the central banks of their countries, so much as they can be. And the levers are relatively crude, but interest rate certainly is a very big lever. The reason the Australian dollar was so extraordinarily high for so long is because the Australian Reserve Bank was paying interest rates on government bonds at about 4 times what anyone else was paying on their bonds. And they've continued to keep rates relatively high for reasons that I don't quite understand. But that's certainly going to be a big step going forward with this US dollar index. In fact, as early as recently as today, you've got Ambrose Evans Pritchard, who's a very respected economics writer for the UK Telegraph, saying that this US dollar index is too rich, that it's too high, that it's harming exporters. Well, honestly, in the era we live in, there are just a number of people, great numbers of people, who are paid to have controversial views. And if you're writing articles, which I used to do for many years, you've got to say something a bit controversial to catch people's attention. But it goes much further than that. The universe these days of the Twitterati and Facebook, none of which I use or understand, has really just created a theatre for the great unwashed to spew their rhetoric, I should say. And Ambrose is not in that class at all, but he certainly peddles a political line, and the political line that's starting already from the US Chamber of Commerce is that this is a high level for the US dollar index, and it's hurting their members, who are the large manufacturers and exporters. Okay, anyway, just keep an eye on that level, 100.840. A close above that implies a breakout to much higher levels. Let's move on now and have a quick look at what's been happening in the S&P market. Let me just check off what I've got notes on here to talk to you about. Oh yes, big deal. Options expiration tomorrow. I have here a piece for you to just show you the absolute magnitude of this options market. This is a paragraph today from Zero Hedge, who are a interesting publication. If you want to read it, it's a lot of it's very controversial, and they do certainly have agendas that they push, but they also are very, very smart guys on markets, and sometimes they get stories on international things that are happening before the other media. So it's worthwhile having a read now and again. Don't get too serious about it. A lot of it's tongue-in-cheek. But I wanted you to see that the triple witching, which is now the quad witching of all the options expiring on Friday. $1.1 trillion of S&P 500 options. Give you an idea of how big these markets are that we're trading. The reality is that the people who write options are the smartest people in the business, and they usually seem to follow the Daniel Code and know which way markets are going. As you know, we had buy signals earlier this week for, let me just go and find a market for you here. Let's have a look at the Russell TF. Here we are. Contract roll. This is now the March contract. We had a buy signal for Tuesday. Up it went, and we had a sell signal for today, and it's turned around and gone down as we expected. Same thing with the S&P. We had buy signals for Tuesday. You could have run them into Wednesday, and a sell signal today for Thursday. So what's going to happen with these markets is going to be interesting, but we're running into the end of the year incredibly quickly. I had real trouble today understanding that next week is Christmas. It's just been so busy, but next week is Christmas, folks, and Thursday, in fact, is Christmas Eve, and Jerry kindly sent me this document and asked me to show it to you. Let's see which marker your desk screen should change, certainly. Here it is, and as you can see, nearly all these markets are going to have a half day on Thursday. Let's get down to the equities. Here's the equities. This is Christmas Eve. There's a half day only. Day session closes at 12:15, and then you're into the Christmas weekend. For the end of year trading sessions, Thursday the 31st, same thing. The day session is going to close early. Down here is our line on equities. It's got a normal close, but you can see other markets close earlier. Livestock's going to close at half day. Dairy, we don't do much of that. Half day. Lumber, half day. Normal close in equities, interest rates, and financials. And we're going to, of course, here, we're going to be closed after New Year's Eve. I'm actually doing a tutorial right up until Christmas Eve, and once I finish that with you, Steve, we'll be closed for the Christmas holiday, and we'll be back on the trading day. It's going to be Monday the 4th of January. It's going to be the first full trading day after the New Year holiday. Okay, we'll have to think about how we're going to fit a webinar in there. That's going to be our normal 2 weekly webinar. Would fall on December the 31st. I think most of you folks will be celebrating New Year's Eve with your families and friends, so you probably don't want to hear from me then, and I might be celebrating it as well. It's been a stunning year, hasn't it? We've just had a great year trading. Let's move on because we've still got lots of stuff to see. Let's go and see what's happening in the equities and how they've been affected. This is just what's happened since the rate rise. This is Tuesday. We had a buy signal for Tuesday. Wednesday was the day that the result was released. It closed on a pretty bullish note. Lots of positive comments, and then we had a sell signal for today. And look what's happened. It's given up almost all of those 2 days of gains, or a good percentage of them. So market's not really convinced that this 25% basic rate raise in the rates means anything. And in fact, it's an excuse for banks to raise interest rates on loans. So I suppose the Fed will congratulate itself on that. But how's this going to flow through? We don't really know. And there's a great number of issues going on, folks, that are not related specifically to interest rate rises. Iron ore is a big deal in Australia. It's its biggest export. Prices are down from 120, 130 down to $38 or so. A lot of the miners are having to stop producing. The big miners, BHP, Rio Tinto, and Vale. You might add Fortescue into that list, but certainly the first three are producing additional output, so they try to gain market share as the weaker players, the high-cost players, are forced to close down production. Oil is at historic lows or multi-year lows. It's not really historic at all. It's, let me bring up the 24-day chart for that, because as per trend, let's go to oil. Here we are. You can see it's nothing like historic. Oil's down here was down at about $10, and it's still a bit like gold. It's coming down, but it's still pretty high. You can see that we got a couple of closes near this 50-70 number that caused a 2-month rally. This is the 24-day chart. We had great target recognition at the blue line at 37.66. That forced the rally up. It tested the 50-70 line from the other side, which it does. Now you've got a break of the black line. If that bar should close there, it tells you that swing's going, and it's heading to 31.44. Probably the next important number for oil. But in terms of what's this doing to some economies, it's pretty drastic. Saudi Arabia, that's been ripping off the rest of the world very successfully since the war, has had to borrow on the money markets to meet its budgetary requirements. And this is all a play by the major oil producers to try and force out higher cost producers. And shale oil in the US is the main target for this move. Shale oil is a relatively expensive source of oil. And the idea is that if they can force those guys to the wall, they're going to be able to increase their market share and their monopoly on pricing for the OECD, for the OPEC countries. This is becoming a real issue for some companies. You look at what's going on with BHP, for example. They've been getting a whack by the iron ore price collapsing, but they're also in the oil business, and they're getting a double whack because of the price of oil. It's a very significant company worldwide, but particularly in Australia. Natural gas is having a torrid time, just as Australia is about to become the biggest natural gas oil exporter in the world, which will happen when a few more of these projects come on stream in February. There's a whole lot of drama bubbling below the surface. Iron ore, oil, natural gas, All of these are large issues, and we're seeing them most visible in Australia because that's where the biggest effect of the boom has been seen. And that, I suspect, is where we're going to see the biggest effect of the bust, if you can call this a bust. I don't call it a bust. It's just merely a correction, but it's a significant correction. And Australia is a relatively small economy exposed to these very, very big international markets. So by watching what's happening in Australia, this is a bit of a canary in the coal mine situation. We can get more visibility on what's happening with the bigger economies around the world. And I think there's some real problems going forward to 2016. I mean, oil, iron ore, copper, natural gas, all pricing depressed. And many of these markets, these newer players, have been built. The business model is on sustained high prices. It's really only the big legacy producers who are going to be profitable and remain profitable at the prices we've got. And there's no reason we won't see lower prices. I mean, this is the gold bugs argument. Oh, gold can't go lower. Oh, well, it's cheaper now. It must be a good buy. It doesn't follow. Trends can remain in force much longer than you can remain solvent. And there's nothing at the moment. There's hope that 2016 will be a better year for these producers of these big primary products. Primary in the sense that they're of primary importance to building and development and power. But there's no guarantee that it's going to be better. In fact, it could go an awful lot lower. If you took the just looking at this chart we're looking at now at oil, there's absolutely no reason why this is going to have to stop around 31.44. If it gets there, which I suspect it's going to get there reasonably quickly, that's going to be a big rallying point because it will have taken out the big long-term swing from November 08. There'll be a ton of stops under there. I don't know why people would be silly enough to have their stops under there, nor do I know why people would be silly enough to sit through this sell-off, which has been going now since June 2014. But nevertheless, there'll be a ton of stops under there. Once they get hit, there'll be a liquidity burst, and then you'll get a rally. But there's nothing to say that has to hold the market at all. And all of this idea of long-term pricing is a victory of hope over logic, because the fundamentals are not A, not there, but B, they're not known. You have we're not allowed to say there is a cartel, but I'm not suggesting there is. I mean, we know that OPEC is a cartel, but even in the iron ore space, cartel behavior is illegal in many countries, including where I am and you are. But the economic rationalism of saying when you're the low-cost producer, you drive production to drive others out of the business. That's what's going on now. Well, let's see where it all ends. New Zealand is going to be in a parlous situation. They're so dependent on the dairy trade. They've had 1.5 tougher seasons. They forget that they've had years of just record prices for dairy, as usual, with not just dairy farmers, but all these corporates. Nothing's ever put away from a good day. Nothing's ever put away for a rainy day. It's always spend it, believe it'll go forever. And the reckoning might be upon a whole lot of industries next year. Certainly another tough year for the dairy people in New Zealand is going to cause absolute havoc. The price of dairy, land and cows is just beyond belief. It's a bit like the real estate market in Australia. Finally, I've been saying for at least the last 6-7 years that prices are between 6 and 8 times earnings, and I always get screamed at for saying that. No. The historic basis is 3 times. It's gone up to 4 times, which of course has been rubbish for a long time. The exponential growth in home prices around the world is driven by a socio-economic event, the change to women almost universally working. In other words, previous single-income families, traditionally single-income families like my family, the next generation have become dual-income families. And that's pretty much increased earnings per family by perhaps 80%, perhaps double in some cases, much, much more. And that's been the primary driver of the increase in housing prices. But we finally got someone, recognised statistician, to come out and say, in the capital cities of Australia, he's talking about Sydney and Melbourne, prices for residential housing are the highest in the world, and they are 12 times average earnings, which is completely unsustainable. It's been an absolute phenomenon. It's going to be a really interesting study for people to see how players have been able to trade up using the equity of this massive historic property boom. I mean, you're talking about prices in Melbourne last year increased 24%, 23.6%, nearly a quarter in 1 year. It's been going on for years. I mean, it's absolutely staggering. There'll be consequences for that as well. I'm really looking forward to 2016 because I think it's a year that you're going to see some serious carnage in very important markets. And as traders, we love carnage. The carnage breeds volatility. Volatility is what traders thrive on. So as far as I'm concerned, bring it on. The sooner the better. But anyway, that's just my view. Let's get you on to the S&P so we can see what's happening there. And let's start with our 6-day chart, and let's go to the S&P wherever we can. We use the index. This is $SPX, and you can see, you've seen this chart many, many times. In fact, I show it to you every time we have a webinar. This is the S&P index, and you can see that this is run along the Daniel Code trading channel perfectly since the 2009 low, and this red line is a full seal line that gave us this forecast high in May 2015. Important thing is that this solid blue line through the middle here, that's the mean, and these lines above it and below it are respectively 1 standard deviation and 2 standard deviations from the mean. And what we're looking for before we can signal a change in trend is a close below 1 standard deviation from the mean, and we don't have it. What we had here is we had a collapse from 1 standard above the mean plus quite a bit down to 1 standard below the mean. That's absolutely normal behavior for this index and all others. You can see this market here is hitting the 1 standard deviation above the mean, keeps running between the mean and 1, down 1. This is the only time since the 2009 low that's gone to 2 standard deviations from the mean. It hit that, reversed, took off like a scalded cat, kept tracking the median up here, back up to 1 above from the mean, 1 above, over 1 above, follows it, correction to the mean, bounces off, and now we've got this, what's happening here. What's happening here is we've had a decent pullback. The most significant pullback since mid-2012 was the last time we got down to 1 standard mean, 1 standard deviation below the mean, and we've had a rally up because what this market will try to do when it's done that, it will try to find the mean again. This is the mean right here. It's this dotted line through here. So it's found the mean, it's holding around the mean. It will now try and get back. It'll probably run along that mean until it gathers strength, and then it will try and get back to 1 standard deviation above the mean. However, if we get a close below this line here, which presently is at about 1951, a close below that on the 6-day chart is a sign that the whole of the bull market is over. So this is a chart that you want to watch very closely. You don't need to panic about it. We'll have you the right way at all times, as we have. But your trading comes from the daily bars. But if you're thinking about what markets are and where they're going, this is very important. Let's move on and have a look if we have anything on the 12-day chart of significance. This is the 12-day chart. Looks very messy, doesn't it? There's a lot of stuff on here, but this is the key. This was 148. This is the extension of the 59 cycle. There is the 59 is time, that makes the 89 time and then half. The 118 is times, and the 148 is times and then half, just exactly as Daniel told us 2,600 years ago. And that, together with the intersection of all of those red lines, all of which are either fourth or fifth seal lines, told us that that was likely an important turning point, and at least an intermediate high, which it turned out to be. Let's go and have a look briefly at the trend chart, which is the 24-day chart. Let's bring up the S&P on that. And as you can see, it's just been a slingshot, hasn't it? Pretty fantastic. There was the time cycle we had right there. It looks a bit, I put that arrow there to show you. That's the 118 Daniel Code time cycle right at that high there. And you can see, just look at this Daniel Code trading channel, which has controlled this market at all times, as it does. You can see that the market just topped out a little bit earlier, rolled off waiting for time, and then has dropped down to one standard deviation from the mean. So the trend is still up in US equities. We have had not much rumble or just really good trading. Market moving both ways, which we love, and that's been great. So that was the main thing I wanted to talk to you about, folks. I think 2016 has just been a fabulous year's trading, the best I can remember, and hopefully I can keep making it better for you into next year. For those of you who've supported us during this year, thank you very much. Hope it's been great for you, and those of you that are thinking about it, please take my suggestion and organise a free trial for 30 days and see what you can learn from all of this. Pete, yes, thank you. Yes, no, it's all right. It didn't get in. It didn't get in. I don't know if the other people at the tutorial appreciate this. It's really a sort of New Zealand Australian joke, but I'm Australian. I've had properties and cattle properties and grain properties, horse properties most of my life, so I'm very used to Australian snakes. We have some of the most vicious and dangerous snakes in the world in Australia. In fact, pretty well everything in Australia who wants to eat you or kill you. But in New Zealand, it's a bit like Ireland, where St. Patrick banished the snakes, and I don't know if he ever got to New Zealand, but for whatever reason, there are no snakes in New Zealand. And I've had, as some of you know, 12 or 13 years in New Zealand recently, and my wife is a Kiwi, which is what we call New Zealanders, and she wanted to go and give her elderly family a bit of help, and I said, yeah, okay, we can go over there for 6 months, which we did, to a beautiful town called Taupo. It's on a huge lake in the middle of the centre of the North Island of New Zealand, and our 6 months finished up becoming almost 13 years. So Mrs. Needham knows nothing about a snake, being a Kiwi, doesn't know that snakes are dangerous, they can bite you and kill you. And my children, of course, been pretty much raised in New Zealand, so they don't know about snakes either. And I was out I spent 2.5 years since we've come back to Australia saying to my wife and children, keep the doors shut. We have, screen doors inside the glass doors. Keep the screen doors shut or you're going to finish up with a snake in the house. And, someone's going to get badly hurt, if not killed. They've never seen a snake. They don't know how dangerous these things are and how fast they can move and everything else. And it's, Dad, Dad's going on again, blah, blah. Anyway, I was out with Pete and Phil and Louis and Brian on Phil's beautiful cruiser on the Auckland Harbour. And I just got to New Zealand the day before. And I got this panic text from my wife that she'd been putting up the blinds, and there was a large black snake on the veranda a couple of feet away from the doors to our lounge, which of course were wide open because Mrs. Needham's a Kiwi and wanted to have the doors open. I've got to have the air coming in. We've always done this. I've always lived with the doors open. Anyway, here was this big black snake about to come in the house. We had an instant panic as to whether, in fact, by the time she'd got around the corner and closed it. I said to her, "What did you do?" She said, "I froze." That's not a great thing to do when you're dealing with an imminent threat of danger. Anyway, so I was on the boat and drinking beer, sitting off the beach at Takapuna, having a nice lunch. Was wonderful. And poor Mrs. Needham was worrying about, did we get the snake inside? Apparently it's not inside. It certainly hasn't been seen since, but it was very close. So that was the joke that Pete was referring to, wishing me a snake-free and Merry Christmas. Thank you, mate. That's great. Let's see what we've got. Any other questions here, folks, before we wrap up here? Thank you, Don, and to you too. Akshay, happy Christmas to you too, mate. I don't know whether I can devote a webinar to Nifty. I don't know that we have any traders left of the Nifty, but if anyone else is interested in the Nifty, which is India's Nifty 50, it's particularly good with the Daniel code. Send me an email, if you would, to jneedham@thedanielcode.com, and I will include some coverage of it in the next webinar, as Akshay's requested. Or for anything else, any other markets you're interested in, or any questions on trading that you'd specifically like me to cover, please send me an email, jneedham@thedanielcode.com. Okay, so that's great. Good, thank you. Marcel, my friend, yes, happy Christmas to you. It's cold up there, Marcel. It's the middle of summer down here, you know, and I'm about to go for a swim. But you, Terry tells me you haven't had much snow up there, but I know that you're in a different place to where Terry is. So good luck over Christmas, my friend. Sue, thank you. Yes, glad you're enjoying them. It's great. Marcel says it is snowing. You know, Marcel's up in Canada, in Ontario. Is it? Well, it's the French part, isn't it, Marcel? Marcel is, I think, sort of a French Canadian. Sue, thank you, darling, and to you too. Marcel, my friend, happy Christmas to all of our Daniel Code folks, and have a very, very prosperous new year. Be my aim in 2016 to make sure that you plunder the markets for the benefit of yourselves and your families. So thank you, guys, for your kind wishes, and I'll look forward to talking to you all in the new year. In the meantime, lots of happiness and joy. Excuse me, and very best wishes to all of you. Bye-bye.